Welcome to the deep dive. We're looking today at the fixed income SMA market, separately managed accounts.
Right. A huge growth area.
Absolutely huge. Some projections are saying, what, maybe $2.9 trillion by 2026.
That sounds about right. The demand is definitely there.
So for you listening professional portfolio managers, this growth is obviously very interesting, but it brings up a big question.
How to actually deliver on that at scale.
Exactly. How do you give clients that deep customization, that real SMA value, efficiently? Especially, when markets are as choppy as they sometimes get.
Yeah, efficiency and scale are key.
So today we're doing a deep dive into the technology that really enables all of this.
Okay. So first off, just to level set.
Yeah.
An SMA in fixed income, it's different because the investor directly holds the actual bonds.
Right. They own the underlying securities, not shares in a fund.
Precisely. And that direct ownership gives you benefits you just don't get otherwise. Transparency, for one.
And control. Real control over what's in and what's out.
That's the foundation for the customization piece.
Which is a major draw for SMAs, isn't it? Being able to say, okay, exclude this sector or apply these specific ESG screens.
Absolutely. Or managing a concentrated position carefully. Things that are, well, pretty much impossible in a pooled vehicle like a mutual fund.
And there's the tax angle, too. That direct ownership matters there as well.
Oh, definitely. It's crucial, actually. It unlocks sophisticated tax efficiency strategies.
Like tax loss harvesting.
Tax loss harvesting, yeah. Timing specific buys and sells to manage gains and losses.
Right.
That's a significant value add.
Especially for high net worth individuals, I imagine.
Exactly. That personalized tax-aware management is a really big driver behind the growth we're seeing.
Okay, so the value proposition is clear, but delivering that, that highly personalized approach across maybe hundreds or thousands of accounts.
Each one with its own rules, its own preferences.
That sounds like an operational nightmare without the right tools. You can't just throw more people at it, right?
No, not really. Not if you want to be efficient and profitable. Doing it manually just doesn't scale.
So you need technology. What kind of tech are we talking about?
You need a pretty robust infrastructure. Things like advanced portfolio optimization engines.
Built for fixed income specifically.
Yes, that's important. You also need really good data integration, pulling info from multiple sources seamlessly. Automation is key for handling the sheer volume of accounts.
And flexibility, I guess. Connecting with existing systems.
Yeah, flexible APIs are important so the platform can fit into a manager's existing workflow and tech stack.
Okay. So this is where dedicated platforms come in. You mentioned BondIT's Frontier as an example.
Right. It's a platform designed specifically to tackle these SMA scaling challenges. We can kind of walk through how it addresses the key workflows.
Good idea. Let's start with portfolio construction, building the actual portfolio. How does something like Frontier help managers build optimal, data-driven portfolios, but still keep that client customization?
Well, it starts with pretty powerful optimization algorithms, as you said, tailored for fixed income. But then there are tools layered on top, like an investment parameters function. They call it IPS sometimes. It lets you create these really detailed, customizable rulebooks or model portfolios that capture your specific investment strategies.
So you codify your approach.
Exactly. And then there's a custom universe tool. Think about it. Millions of bonds out there. This lets you filter that down to a very precise, relevant set based on all sorts of criteria.
Even things like your own internal research or liquidity scores.
Yep. You can incorporate those too. Very flexible.
Okay, portfolio built. But markets move. Fixed income is dynamic. What about rebalancing and doing it efficiently?
Right. That's where you get huge operational leverage. Frontier offers real-time rebalancing. It's driven by that same optimization engine we just talked about.
So it suggests changes based on market moves or cash flows.
Yeah, and you can set very specific constraints for that rebalance. Target duration, maybe a maximum number of trades, turnover limits, things like that.
And you can see the impact.
Instantly. It shows you side-by-side comparisons. Proposed portfolio versus the current one. Makes decisions much easier.
But the scale. You mentioned thousands of accounts earlier. Rebalancing them one by one still sounds tough.
But that's the key. Batch optimization and automation. That's really transformative for efficiency.
Meaning?
The platform can process rebalance proposals and even generate the necessary block orders for potentially thousands of portfolios all at once.
Thousands, simultaneously.
Simultaneously.
Yeah.
That's how you get scale and expand your capacity without just hiring endlessly.
Okay, makes sense. Beyond the portfolio decisions themselves, there's trading, execution, especially if you're doing block trades for many accounts. How does the tech help there?
Good question. It provides access to aggregated live liquidity.
So seeing prices from multiple places at once?
Exactly. Across multiple ATSs, different electronic venues, that wider view helps you source bonds better, potentially find better pricing.
And the workflow is connected.
It's integrated, often supports click-to-trade right from the platform. And it has automated trade features designed to help with best execution, especially across those large batched orders.
What about keeping an eye on things? Monitoring portfolios, adapting to changing markets.
There are tools for that, too, like a smart search feature to quickly find specific bonds that meet certain criteria.
Including liquidity metrics, so you know if it's actually tradable.
Yes, incorporating liquidity indicators is important. And there's scenario analysis.
Stress testing.
Kind of. Modeling how portfolios might perform under different conditions. What if the yield curve steepens? What if the dollar weakens?
And day-to-day monitoring.
Continuous monitoring, yeah. Alerts for any guideline breaches or flags for accounts that might need specific attention. Keeps things on track.
That monitoring sounds crucial. But, markets can get messy. What happens if it's literally impossible to meet all the client's constraints and your targets at the same time? That must happen in volatile periods.
Oh, absolutely. It's a real-world challenge. And that's where a function they call solve anyway can be really valuable.
Solve anyway. What does that mean?
It means the optimization engine finds the closest possible portfolio solution, even if it can't perfectly satisfy every single constraint.
Okay.
But critically, it doesn't just give you the portfolio. It shows you exactly which constraints had to be relaxed and by how much to get to that solution.
Transparency. So you understand the trade-offs you're being forced to make by the market.
Exactly. It really helps with making those difficult decisions and explaining them if necessary.
Let's connect this to the real world. Think back to, say, the turbulence we saw in the 2025 fixed income market. You had volatility, policy uncertainty. How would these specific capabilities help a manager navigate that kind of environment?
Great question. Take April 2025. Remember those interest rate spikes?
Yeah, things got volatile quickly.
Right. So having that real-time rebalancing coupled with the batch optimization that lets you adjust duration targets rapidly across your entire SMA book.
So you could react almost instantly.
Pretty much. You could deploy shorter duration models you'd already built or react to those, say, 30-year yields hitting highs across thousands of accounts very quickly, something you just couldn't do manually.
And finding bonds when things seize up? Liquidity dries up sometimes.
That's where the aggregated liquidity view and the smart search become vital, finding actual tradable inventory when markets are fragmented or stressed. Scenario analysis helps too.
How so?
By letting you stress test portfolios before the storm hits. What happens if the curve steepens further? What if the dollar tanks? Having some insight beforehand is powerful.
And just maintaining service levels? When volatility spikes, clients get nervous, rebalancing needs shoot up. Doing that without batch processing seems
unsustainable. Yeah. Batch optimization is really key to just maintaining operational efficiency and keeping clients happy when things get wild. And that solve anyway function helps avoid gridlock when market conditions really clash with specific client rules.
Okay. So pulling it all together, fixed income SMAs, they clearly offer a lot of value. Customization, tax efficiency, driving serious growth.
Undeniable value. But scaling that offering, making it work efficiently, especially when markets are throwing curveballs, that absolutely requires sophisticated technology.
It's not optional at scale.
Not really. Platforms like BondIT Frontier, they provide the necessary toolkit. Efficient construction, customized strategies, fast rebalancing, smart trading, all that monitoring and analysis.
It seems essential, especially in today's fixed income landscape, which leads to, I guess, a final thought for you, the listener, to chew on. As the fixed income market keeps moving towards more electronification, more personalization, what does the future really hold for firms that don't embrace these kinds of next-generation technology solutions for their SMA offerings?